If my business plan is to go into apartment building, buy for 5 years, 3 to 5 years, I implement my business plan and I exit maybe year 3, year 4, not even exactly 5 years, right? So I have taken all this depreciation through the cost segregation and the bonus depreciation. What is going to happen at the exit from the recapture perspective and how that's going to impact my investors?
That's a great question, Vinki. So when you sell an asset, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. And that depreciation recapture tax is calculated based on the amount of depreciation you've taken. So I'm sitting here saying, front load all this depreciation, take it all in the early years. And you're right. People will ask us, well, Erik, doesn't this just mean I have a bigger tax bill when I sell it?
Mm-hmm.
The answer is no. And I'll kind of explain to you why.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have Erik Oliver with me. Welcome to the Real Estate Vibe Show, Erik.
Oh, thank you. Thank you for having me. I'm excited to be here.
Likewise, Erik. So a little bit about Erik. Erik holds a bachelor's degree in applied science in accounting from Westminster College. Erik's journey started as an operations manager for a big landscaping firm in Long Island, New York. But here's where it gets exciting. After heading west to the Cost Segregation Authority, Erik's been making waves, speaking at local, regional, and national events. His mission? To help commercial real estate owners uncover savings and understand the perks of cost segregation. And today our topic of discussion is Mastering Real Estate Taxes, your guide to financial success. So Erik, let's start with a basic overview. If you can provide us an overview of your understanding of real estate taxes, how crucial is it for the financial success in the real estate industry?
Oh, yeah, absolutely. That's a great question. So, I look at real estate taxes. So let me preface by saying I'm not a CPA. So my degree is in accounting, but I'm not a CPA. So you definitely want to run all this stuff past your CPA. But the tax side, I look at it like a lot of real estate investors, the tax side sometimes gets forgotten. So we're all excited to go buy a new property, to add more doors to our portfolio, go buy a new industrial property, so we can create that income and that cash flow coming in. But oftentimes it gets overlooked at what's happening on the backside. So the tax side, we pay too much in taxes. One of the benefits of owning real estate is the ability to take depreciation and write off some of these, create a business, write off these expenses. And oftentimes that gets overlooked because we're so focused. A lot of us are so focused on that front end. I grew up playing sports, and so I'll use a sports analogy. I played basketball. So if you score 100 points, if your team scores 100 points, that's great. But if the other team scores 101, you still lose, right? If you don't play defense. And so I look at the tax side kind of as playing defense in a sports analogy, because again, it's not what you make on the front end if you turn around and pay all that out in taxes. And so you've got to have a real tax strategy on the back end to be able to save some of that wealth that you've created on the front end. And so it's so important to make sure you've got a good tax strategy, that you're working with a wealth advisor or a tax strategist in order to put that into place. Because oftentimes, I can't tell you, Vinki, how many times I've seen or worked with large real estate investors. They've got huge portfolios, and I say, okay, well, let's get your CPA on the phone and let's talk to them. They're like, well, I do my own taxes. I do TurboTax, or I go to H&R Blocks at the Walmart in the parking lot, and they do my taxes. I'm like, no, you guys, you've got such a big portfolio. You're probably way overpaying in taxes, and so it's a very important strategy when investing in real estate is looking at that tax side. And don't forget about it, because oftentimes it goes forgotten.
That's true. I agree with you. But let's talk about some of the effective tax planning strategies that real estate investors can implement to optimize their tax position.
Sure. So there's a couple. There's a lot of your listeners have probably heard of Opportunity Zones. Opportunity Zones is a program that came out with the Tax Cuts and Jobs Act, which allows you to reinvest capital gains into certain pockets of the community that have been designated. And if
Mhm.
so, there's some tax benefits on the back end. So if you invest in it, if you improve those properties, you may not have to pay tax on any of that gain. And so that's one thing. The other thing would be obviously 1031 exchanges. That's another program that's very popular. I myself am not an expert at those, but basically what those are is a similar program where you can take the gains from the sale of one asset, invest those into a new property, defer the gains. You kind of defer. Unfortunately, we all pass away at some point. So when we pass away, our
Your
estate,
heirs can.
yeah, our heirs will get a step up in basis and nobody pays tax. Those are two of the more popular. The third one is kind of where I come in, and that's the cost segregation side. So cost segregation is just a great tool to be able to accelerate the depreciable assets within your real estate. So normally real estate gets depreciated over 27 and a half or 39 years. So if it's a residential units, it's 27 and a half. For commercial units, it's 39 years. So essentially, just to make the math easy, Vinki, we'll say, let's say you buy an office condo for 390,000. You take that 390,000, divide it by 39 years, you're getting a $10,000 write-off every year for the next 39 years, which that's great. You know, everyone loves write-offs. And so a $10,000 write-off is great. The problem, Vinki, is I might not own that office condo for 39 years. Hell, I might not even be alive in 39 years the way that I eat, according to my wife. So she says, get your deductions now versus letting the IRS hold on to those. And that's kind of where cost segregation comes in, because we go into the property, identify short-term assets, put a value to those assets, which allows us to front load or take that depreciation at a much faster rate.
So let's dig deep a little bit into the cost segregation. So how exactly cost segregation work? Like you said, the terminology cost segregation. Some of my viewers, they might know that. Some of my viewers might not know that. And there's addition to that, there is something called bonus depreciation too. So let's start with cost segregation first. How does that work, and how we can just write out the property year one versus doing 39 years?
Yeah. So as I mentioned, the normal schedule would be 39 years. So let's say I buy an office condo for 390,000. I take the closing statement, I give it to my tax preparer come tax time. They're going to put that in as one big asset depreciated over 39 years. What cost segregation is, just as the name implies, is we're taking that cost, or that 390,000, and we're segregating it into different buckets per se. There's a 5-year bucket, a 7-year bucket, and a 15-year bucket. The 5-year bucket is all of your internal components of your building that are non-structural. So example, here in this office, it would be the flooring. It would be the window covering. It would be part of the trim. It would be the TV over there. All the inside stuff, the IRS says should be depreciated over 5 years, not 39, which makes sense. My carpet's not going to last 39 years. It only lasts 5 years on average. So those are our 5-year assets. So in a cost seg study, we would come out to the property and say, okay, of that $390,000 purchase price, you've got $12,000 worth of carpet. You've got $4,000 worth of window coverings. You've got a $60,000 parking lot. All the exterior stuff, those are our 15-year assets. Things like our land improvements, curbs, gutters, asphalt, trees, bushes, and shrubs, fencing. All the exterior components of the building get segregated into that 15-year bucket. By taking that $390,000, breaking it up into little asset classes, we now get to depreciate all of our 5-year assets over 5 years versus 39. So they get divided by 5 versus 39. Our 7-year assets get divided by 7. Our 15-year assets get split up over 15 years. And now we've front loaded, or we get to take a much bigger deduction in those early years. Because remember, I may not own my building in 39 years. And so I want my deductions now versus in the future. So that's kind of cost segregation 101. That's a high level overview of cost segregation. Now, you had mentioned something about bonus depreciation. So with the Tax Cuts and Jobs Act, well, let me back up a little bit. Bonus depreciation has been around for a number of years. The IRS uses bonus depreciation to stimulate the economy. So if the economy is not doing well, they'll increase the bonus percentage. If the economy is doing well, they'll decrease the bonus percentage. But bonus depreciation basically accelerates your depreciation even more. So I'll give you an example. Back in 2017 at the time, bonus depreciation was at 50%. Bonus depreciation was applicable to any brand new asset. It couldn't be a used asset. It had to be a brand new asset, and it had to have a useful life of 20 years or less. So if I was a contractor and I went and bought a brand new bulldozer, and that bulldozer had a useful life of 20 years or less,
Mm-hmm.
I would be able to take 50% bonus at the time. So if that bulldozer was $1 million, instead of spreading out that million over 20 years, I would get to take 50% or 500,000 up front as a deduction.
Mm-hmm.
The other 500,000 would get spread out over the useful life of that asset, which is great.
20 years, right? Which is the
Yeah, it encourages people to go out and buy stuff. So that was at the start of 2017. By the end of 2017, as many of your listeners are aware, Donald Trump was our president. Donald Trump owned real estate, and Donald Trump proposed some tax changes with the Tax Cuts and Jobs Act. And one of those changes was they changed the rules for bonus depreciation. So two things happened. The first big change was they went from 50% bonus to 100% bonus.
Mm-hmm.
So that's big. Remember, so now if I buy that $1 million bulldozer, instead of writing off just 50%, I now get to write off the whole thing, the whole $1 million, which is great.
Mm-hmm.
That's the first big change.
Mm-hmm.
The second big change, which I think was a little bit more important because I think it had a bigger impact, was they added 5 words to the tax code. So remember I said, Vinki, it had to be brand new equipment. I couldn't buy a used bulldozer. I had to buy a brand new bulldozer.
Mm-hmm.
Well, under the Tax Cuts and Jobs Act, when they added these 5 words, they added the words new to you, the taxpayer. So now I can go buy a used bulldozer. That used bulldozer is new to me, the taxpayer. And all of a sudden I'm eligible for 100% bonus because remember, it changed from 50 to 100. So question is, Vinki, how does that relate to real estate? I was talking about bulldozers. Let's talk about real estate. So the way that impacts real estate is now I can go buy a used apartment building, right? It's been in service. Let's say it was built in 1980. I buy it in 2022. I would be able to do a cost segregation study. Remember, it has to be a useful asset of 20 years or less. An apartment building is normally depreciated over 27 and a half. So it typically doesn't qualify for bonus. However, if you do a cost seg study, we now can identify the 5, 7, and 15-year assets within that office building, or excuse me, within that apartment. And now those assets, because they have a useful life of 20 years or less, they're now eligible for 100, or they were eligible for 100% bonus. Now, let me just back up because I think I might have confused some of the listeners. The 100% bonus was in place for any assets placed into service between 9/27 of 17, so September 27th of 2017 through 12/31 of 2022, you were eligible for 100% bonus. Here in 2023, when we record this episode, you're eligible for 80% bonus. Next year, it drops to 60% in 2024, then 40%, then 20%, all the way until 2027 when it's 0% bonus. Now, that's the current sunsetting period.
For the bonus.
Yeah, for bonus. There have been talks in Congress. I think the Ways and Means Committee has already put forth 2 proposals that would extend the 100% bonus all the way through the end of 2025. But when Congress gets together here in the fall, they may vote and they may extend the 100% bonus. But currently, as we said, it's 80%. So what does that mean? You would get 80% of those 5-year deductions all in year 1. The other 20% gets spread out over the useful life of that asset, so over the next 4 years. So that's kind of how bonus works. That's kind of how bonus is going to phase out. But again, a lot of that could change. You've got an election coming up. An election could change that. The Congress could change that. But currently, for 2023, it's 80% bonus depreciation.
Yeah, like we were talking earlier, these regulators and the lobbyists, they are all the revolving doors. So things can change anytime, basically. Anything can happen anytime. So coming back to the cost segregation, so bonus depreciation is kind of phasing out over the course of period, could be like to 0 again in 26, like it was before 2017. But cost seg is still in place, right? So you can still use that, the depreciation 5, 7, and 17 years, because you're still segregating the components of the building and trying to write off in a shorter time versus 39 years time frame, because bonus depreciation was on top of whatever you are getting, the tax benefits being part of the cost segregation study.
No,
Is that a
absolutely.
statement? Right.
Yeah, that was a great explanation.
So, right. So, I mean, even though we say we go back to zero on the bonus depreciation, but there are still tax benefits by investing in real estate being part of the cost segregation study that you do when you buy the property. Is that a correct statement?
Yes, yep. We were doing cost segregation long before bonus. It still is way beneficial to depreciate something over 5 years versus 39. It's just now that we have bonus, it just puts these assets on steroids and says, okay, these 5-year assets, we're going to give you even a bigger deduction in year 1. The other stuff gets spread out over the next 4. But yes, you hit it on the head. Bonus depreciation is an added benefit. Basically, it's cost segregation on steroids. But yes, cost segregation is still in and of itself a very valuable tool for real estate planning and for tax planning and real estate owners.
So let's talk about recapture here as well. That's going to be a valid discussion, because since we are doing all this cost segregation study and we're trying to figure out how much we can depreciate in 5, 7, and 15 years, and plus we're utilizing the bonus depreciation to just like accelerate the savings right there. So let's say if my business plan is to go into apartment building, buy for 5 years, 3 to 5 years, I implement my business plan and I exit maybe year 3, year 4, not even exactly 5 years, right? So I have taken all this depreciation through the cost segregation and the bonus depreciation. What is going to happen at the exit from the recapture perspective, and how that's going to impact my investors?
That's a great question, Vinki. So when you sell an asset, you pay 2 types of tax. You pay capital gains tax and you pay depreciation recapture. And that depreciation recapture tax is calculated based on the amount of depreciation you've taken. So I'm sitting here saying, front load all this depreciation, take it all in the early years. And you're right. People will ask us, well, Erik, doesn't this just mean I have a bigger tax bill when I sell it? The answer is no. And I'll kind of explain to you why. So the whole idea behind cost segregation is you're going to take your deduction the year you buy the asset against your ordinary income of, let's call it 40% tax bracket, right? Your standard, your federal rate is 37%. Your state and local rate might be 5%. So you're taking it at roughly at 40%. If you sell that asset, you're paying it back at a capital gains rate of 20%. Or a recapture rate of 25% and saving the spread. And you're not actually paying it all back. You're only paying some of it back. And let me give you a better example. You buy a building today for $1 million. You sell that same building 5 years later for $2 million. Okay. So all this stuff I bought today for $1 million, I'm going to sell all this stuff for $2 million 5 years from now. When I sell that stuff and I go to settle up with the IRS, I'm telling them that everything is doubled in value, right? I bought all this stuff for $1 million. All this stuff is now worth $2 million. And so I pay tax on that $1 million of gain. Well, my land might have gone up in value and my walls might have gone up in value, but my dirty, nasty carpet that's 5 years old is not worth double what I paid for it 5 years ago, right? It's actually worth 0. Remember, carpet is a 5-year asset. So the book value of my carpet after owning it for 5 years is 0. I shouldn't be selling it for anything. So when you sell an asset, there's a tax form you fill out. I believe it's a 4797 tax form, but it allows you to allocate the sales price to those buckets. And you shouldn't be allocating your sales price to the carpet. You should be allocating your sales price to the building. And so in summary, without getting too far in the weeds, take your deduction today at a high rate, pay back a portion of it. That portion is dependent upon how long you've owned it. Pay back a portion of it at a lower rate at a future date, and you're saving the spread. And so even on large assets that maybe you've only held over one taxable year, let's say you buy a $2 million apartment building, you hold it for 1 year, you sell it the next year, oftentimes it still will pencil out and there still will be tax savings by doing a cost seg study, because you're taking that deduction against your ordinary income of roughly 40. paying it back at 25% and saving the spread. And so there's a rate arbitrage that we're playing there, a rate game, where we're able to create these permanent tax savings.
Interesting. So how would an investor treat that? We're talking about at the syndication level, maybe at the bigger level, buying $1 million property and doing the cost seg and selling at 2 million. So these are the big numbers we're talking. So let's bring it down to the investor level. So let's say if I invest $100,000 with you in your $1 million deal that you have, and then I get a K1 from you year one, stating that you were able to write off 100% using the bonus depreciation, and I'm able to use the 80% of that in today's date. And then let's say you sell the property 2 years down the road. So now there's going to be recapture. From my perspective, for the sake of a retail investor perspective, what would it look like, the recapture?
So, there's a lot of factors here. That's a tough question because there are a lot of factors. It depends on their income level, depends on their capital gains rate, but you will have to pay some of that back. So it's important to know, and it's always important, especially in syndication deals, that you talk to your tax advisor before entering the deal, because you do need to know what is the hold time, what is the exit strategy, and what are the implications when I exit. And it could be a significant tax bill if it's not handled correctly. So I want to just make a point here. Cost segregation, not even cost segregation, typically real estate deductions are typically considered passive deductions. So they can only be used to offset passive income. You've got passive deductions, you've got active deductions. So I myself am a W-2 employee, and so I own a few rental properties. The depreciation or the deductions from those assets, they can only be used to offset my rental income or my passive income, not my W-2 income. So that's why a lot of times you've probably heard about becoming a real estate professional for tax purposes. A lot of times, like if my wife was fortunate enough to be able to stay home, maybe we can qualify my wife to be the real estate professional. So we file a joint tax return. Then I can use those deductions to offset my active income. But in the case where you're not a real estate professional, you don't have real estate professional status. And to get that, you've got to spend about 750 hours a year doing real estate. That's the easier test. That's only about 14 hours a week. The harder test is you have to spend 51% of your working time doing real estate. So I'm here at Cost Segregation Authority, 40 hours a week. The IRS is basically saying, in order to claim that you do real estate for a living, you would have to do 41 hours a week in your real estate activities. And that's not going to fly. They're going to know that I'm not working 40 hours here and 41 on my real estate. That's 81 hours a week. I would never survive if I had to work that many hours a week. So if you're not a real estate professional, typical real estate deductions can only be used to offset passive income. And so in the case where you're receiving through a K1, a deduction amount or a loss, that loss can only be used to offset either rental income or any other passive income. That's the first thing. The second thing is, let's say that property or my rental property, let's say my rental properties create, I don't know, $50,000 of income every year of cash flows, or not cash flow, actual income. I get a K1 and that K1 has a $100,000 loss on it. I'm not going to pay any tax on my $50,000 of income because I'm going to wipe it out with this $100,000 loss. The remaining $50,000 gets carried forward into next year. And when I create that $50,000 of income next year, I've got this $50,000 loss already on the books, and now it wipes out that income and I pay no tax. Just because you can't use the deduction in the current year doesn't mean it's a loss. It sits on the books until it's all used up. And so that's an important thing to keep in mind, that oftentimes people will get a K1 with a big loss on it. They don't know what to do with it. Well, it just carries forward and you don't end up losing it. Or, Vinki, another scenario is maybe I sell one of my investment properties. I've got this deduction here. When I sell it, this deduction can be used to offset the capital gain on the sale of one of my other rental properties. So there's a number of ways to utilize it.
That's true. And that's the reason we always recommend to work with a CPA, or especially real estate savvy CPA, who knows how to do your taxes, and he can recommend what to do, and then share the strategies, the better way of utilizing all these tax credits or the losses, in other words. So I'm going to ask you next question is, you got the property from somebody, you bought it, you got all the cost segregation, bonus depreciation. So how does that work? The next buyer comes in, buy the property from you, and does the same thing all over again. Like it's the same property changing hands, and the cost seg is done multiple times. And I have heard about this too. A lot of times people, you can do the cost seg at the exit too. Sometimes people didn't do it in the beginning because they didn't need those losses. So they
Sure.
want to do it when they're exiting the property, because you typically have one more year after the exit. And then if you think in hypothetically on the biggest spectrum is the same property. So two people are depreciating, one is at the exit and one is at the entrance. So if you can talk about that a little bit.
Yeah.
It's kind of funny, you know.
No, that's a good question. So you actually had a couple questions there. The first question is, a cost segregation study needs to be done or could be done. It doesn't need to be. It could be done. Each owner would have their own cost seg study, because if I buy the building for $1 million, but I sell it to you for $2 million, when we do the cost seg study on the $1 million, we're going to allocate that $1 million to all the different components. 5 years later, when I sell it to you for $2 million, now all of a sudden those components have a different value to them. They're 5 years older, they have a different value to them. And so one cost seg study per owner, per ownership of the asset is the first thing. The second thing is you don't have to do cost segregation in the year you purchase the asset. You know, you mentioned some people will do it right before they exit. Cost segregation is one of the few tax planning tools that I'm aware of that you can kind of pick and choose when you do the cost segregation study. So you just keep it in your back pocket. If I buy a building this year, but I don't have a lot of rental income or passive income, I don't do a cost seg study this year. Maybe I do it in 5 years when my cash flow starts to increase and I've got a lot of income.
Exactly.
And there is one tax form that has to be filled out when you do it that way. It's called the 3115 change in accounting method. But basically you're telling the IRS, hey, I've been doing my standard deduction for the last 5 years. I'm now going to change the way that I do my depreciation. I'm going to move to an accelerated method. And here's the difference in those numbers. And you get to take that large deduction on your current tax return without having to amend any prior years, which is great. So again, if you find yourself with a big tax liability this year, and you've got some properties that you've owned for a number of years, you can still do cost segregation on those assets and just bring those deductions forward without having to amend any prior years.
And the last question I was asking you about, the exit of the entrance on the same deal.
That's a 2-for-1 cost seg study. So
exactly.
Yes. So oftentimes we'll do a study upon sell, and we could take those same percentages and just apply it to the new sales price. So like I said, the numbers will be different within each study, but the percentages will be the same, because basically there's the same amount of carpet in this building. It's just that you bought all this carpet for $1 million. The new buyer is buying all this carpet for $2 million. So you can use the same cost seg study, or the same, I shouldn't say the same cost seg study. You can use the same percentages and apply it to both the new buyer and the seller. And so oftentimes there's some economies of scale there when working with cost seg companies to be able to take advantage of that, because a lot of the heavy lifting or the hard work is already done. We're just applying it to a different purchase price.
So it's a different purchase price, but would there be some components life could be less too compared to what it was 5 years ago? So that could be like a little bit different study right there that could bring you more dollars back.
Yeah, I think you're referring to what we call a cost allocation report. So a cost allocation report is, upon exiting the asset, you would have a report done that says, okay, now that I've owned this building for 5 years, you guys told me my carpet was worth $1 million. What is it worth today? And by allocating or putting a cost to those short-term assets, there's some tax savings that can be created upon exit of a property as well. So we typically will call that a cost allocation report.
So this cost allocation report, who does that? Is it like part of the cost seg study, or is it like done by the operator?
That's a great question.
What kind of information exactly you need in the cost allocation report?
So typically on larger assets, it does pay to have a company do the cost allocation report. So that's something that we can do here. If it's a smaller asset, oftentimes a tax preparer or a CPA will be able to do that based on some tables that are out there, where they can figure out the value of, for example, the carpet, the value of the parking lot, the value of these different items upon sale. They'll be able to figure those out. And so it just depends on the size and scope of the assets. Sometimes your tax preparer can do these in-house. Sometimes it definitely makes sense to pay for somebody to do these because they're going to get a bigger deduction for you in the end. And so in saying that, I should mention, Vinki, most cost seg companies out there always do a free benefit analysis. And so make sure that you're having somebody run the analysis before you ever pay them. You don't want to pay for a study that you can't utilize or that's not going to create a significant tax savings. And so that's something we do here at our firm is we'll always do a free analysis to say, hey, yeah, this makes sense. And here's why. Here's how much money you're going to save. Here's what our fee would be. And it's just a question of whether we move forward or not. But always have that free analysis done before you ever engage somebody.
That's true. And plus it gives you a little bit more insight, what it looks like. And then if you have any questions that can get answered beforehand. So let me ask you this question. How does the tax treatment differ for various type of properties, like for example, can you do the cost seg on residential? I know commercial you can do it, rental you can do it, but overall just wanted to understand how the tax treatment differ for different kind of real estate properties.
No, that's a good question. So as far as cost segregation goes, you can do cost segregation on any revenue generating property. So this could be everything from a basement rental or a apartment building, an office condo, all the way up to a large commercial, apartment building, hospital, casino, ski resort. We've done golf courses. So cost segregation can be applied to any revenue generating property. You don't get to take depreciation, unfortunately, on your primary residence. So it doesn't apply to your primary residence. And then within all those different commercial assets, all the different asset classes, some generate a bigger deduction than others. So if you think about it, like an apartment building, there's a lot of stuff in an apartment building. So you usually get a bigger benefit on an apartment building than you would on maybe an industrial building that's just a box on top of a cement slab. And so, but in both instances, I mean, you don't ever want to buy a property just for the cost segregation benefits. There's a number of other factors, cash flow and cap rates and all that other stuff. But strictly from a cost segregation perspective, different asset classes will yield different results. But on average, it's right around 30%. So like apartment buildings might get you 35% segregation. Industrial buildings might get you 25%. But on average, you're usually getting somewhere around 30% segregation.
So what if you are using space in your primary residence as a rental? Like, for example, you have a home office and then you're kind of leasing back. So how does that work? Can you do any kind of study on that? Or is there any benefit of doing that?
Sometimes. And the reason I say sometimes is depending on the purchase price of your home, because your depreciation is all calculated based off your purchase price. The purchase price of your home and how many square feet you've allocated to your business use, it may or may not make sense. So let's say you buy a small starter home in some market, it's 200,000 and you're only using 1/4 of that as an office. And essentially you're only going to get a $50,000 starting basis. And so it's probably not worth doing a cost seg study. It's still worth taking that depreciation in its straight line fashion. But a cost seg study, remember, you have to pay for the study. So you got to make sure that the savings that we get on that $50,000 home office is enough to offset the cost of the study. And typically it's not. And so I would say any asset that has a depreciable basis of about 250,000 or greater is worth looking at. It doesn't always mean it's worth doing a study, but you definitely want to look at it. So again, if I buy $1 million home and I use 1/4 of that for my office, now all of a sudden that's worth 250,000. If I can do a cost seg study on that and generate a big enough deduction, then yeah, it's definitely worth it. But that's why you always want to have that analysis done. But the answer to your question is sometimes yes, sometimes no.
Sometimes no. No, I like that. So what is the bottom line, that people should pay attention to, whether they should go for cost seg or no? Because a lot of time people say, oh, it has to be $1 million above, to make it sense. Otherwise, it doesn't make sense to do it. Is there any number?
Yes, I would disagree. So in the past, it did have to be $1 million building because there was no bonus. or the bonus was a lot less, and the studies cost a lot more. With the world we live in now, the tax laws the way they are now, bonus depreciation has made cost segregation more applicable to a lot wider range of investors. You used to have to be buying hotels or casinos or hospitals in order to do cost seg. Now, use me for example. Let's say I buy a $300,000 single family home. When I do a cost seg study, if we segregate around 30% of that, 30% of 300,000 would be 90,000. If I could take 90,000 off my taxable income, if I'm in a 30% tax bracket, that's a $27,000 tax savings. And if the study costs me $2,700 to do, that's well worth it. And so I would say anything over about 250,000 is at least run some analysis on.
Thank you so much. We are out of time. We are actually way over time. So share one golden nugget with my audience.
That's a great question. So the one thing I will share is, as we've talked about this, there's a huge difference between a tax preparer and a tax strategist. Now, tax strategists are going to cost a lot more money for their work, but typically they'll save you tenfold that money on the back end in taxes. And so as you start to build your portfolio, as you start investing in real estate, please make sure you find yourself a CPA or a tax preparer who understands or specializes in real estate, and don't just go to somebody who is just preparing your taxes. You give them your W-2s, you give them your K-1s, they put it in their software, it spits out a number on how much you owe. That's what a lot of people do. And there's a lot of strategy that goes into saving money on the tax side. And you really need to find somebody who understands real estate and is not just a tax preparer, but a tax strategist. And so I'll leave you with that.
I really like that. And I am going to vouch for it 100%, because taxes is something that starts with the planning day one. For the next year, 2024, you should start looking into right now what the tax is going to look like and what are the loopholes are, or what the gaps are, so you can mitigate those gaps. And then you can strategize better tax savings, better investments. So overall, it's just a beneficial for you, not
Sure.
it's just not the number crunching. So this brings us to our vibe rapid fire round. I'm going to ask you 5 questions. You're going to answer in 1 word or 1 sentence.
Okay.
Okay.
If I can follow directions, Vinki.
All right. So the first question is, what is one of the most important things that you have learned in your life, and how did your life change after learning it?
Okay, I can't answer that in 1 question, maybe 1 sentence.
Yes.
Know what you're good at and outsource everything else. You can't be good at everything.
I like that. And this is so right. That's the power of delegation right there. And that helps you scale much faster. Share 1 good book that you read and like it and like to recommend to my audience.
Tax-Free Wealth by Tom Wheelwright.
Good one. In 1 word, what does life mean to you?
Happiness.
See, you got 1 word this time. What is your biggest passion?
Family.
Oh, yeah, that's a good one. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Find a career, go into a career that you truly enjoy, because you're going to spend the next 60 years in that career. And if you enjoy your work, you'll never have to work. You'll always be doing something that you enjoy. So
yeah, plus life is too short. Always do what you love.
Sure.
So how can people reach out to you, Erik?
Yeah, so our website is just www.segauthority.com. My contact information's on there. You can request a free benefit analysis if you've got a property you want us to look at. But please use this as a resource, guys. We don't do tax returns at our firm. So please don't call me and ask me about earned business income or child tax credits, because I don't know anything about that stuff. But we do know depreciation. And so please use this as a resource. If you ever have any real estate tax questions, we're happy to help. If we can't help, we can at least direct you in the right direction. We don't bill by the hour or anything like that. So please use this as a resource. We'd be happy to help.
Thanks, Erik. I really enjoyed our conversation today.
All right. Have a great day. Thank you for having me.